A lot of investors are trying to make a binary trade right now. Bet on totally reopening the economy or bet on things staying closed for a very long time. Want to know how to avoid making that binary trade and collect market-beating passive dividend income in the process? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. I want to tell you about a high-quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is providing millions of consumers with content, entertainment, and most importantly, high-speed broadband internet. It doesn't really matter for this company if the economy broadly reopens or not. Doesn't matter if more people work from home or not. Either way, demand for high-speed internet is only going to increase over time. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Comcast Corporation, which appear to be trading at a significant discount today. Comcast Corporation, stock ticker CMCSA, is a media and entertainment conglomerate with interests in cable, broadcasting, film, streaming, live entertainment, and theme parks. Founded in 1963, Comcast is now a $200 billion by market cap media juggernaut that employs almost 200,000 people. The company reports operations across three primary segments: cable communications, 53% of fiscal year 2019 revenue, NBC Universal, 31%, and Sky, 16%. Cable communications provides 22 million cable video connections, more than 27 million high-speed internet connections, and voice services to approximately 11 million customers. NBC Universal is comprised of several leading cable networks, two broadcast networks, the Peacock streaming service, owned and operated TV stations, regional sports networks, a major film studio, and Universal theme parks. Sky is a major European satellite television broadcaster. Comcast reports insignificant revenue from their corporate and other segment. Other business interests primarily consist of the operations of Comcast Spectacor, which owns the Philadelphia Flyers and the Wells Fargo Center Arena in Philadelphia, Pennsylvania. In addition, Comcast Spectacor has recently entered the esports space, which is being bolstered by the $50 million construction of next-generation Fusion Arena. There's no binary bet here on the eventual outcome of a post-pandemic society. I think things will return to normal within a year or two, but I could be wrong. It doesn't matter though. This company will thrive either way. If the work-from-home model becomes more widespread, that creates additional decentralized demand for their bandwidth. Access to the internet is practically as important as access to electricity nowadays. On the other hand, society returning to normal helps their various entertainment options within the NBC Universal umbrella. The company's hedged bets help to protect their profit and dividend. Comcast has increased its dividend for 13 consecutive years, showing commitment and consistency. The 5-year dividend growth rate stands at 13.5%. That huge dividend growth comes on top of the stock starting yield of 2.1%. Paired together, there's a lot to like here in terms of long-term income possibilities. Notably, the current yield is 30 basis points higher than the stock's own 5-year average yield, and the dividend is protected by a low payout ratio of 36.9%. That low payout ratio puts the dividend in a great position to continue growing. Looking at business growth, Comcast has increased its revenue from $37.937 billion in fiscal year 2010 to $108.942 billion in fiscal year 2019. That's a compound annual growth rate of 12.44%. This is a stunning result, especially considering that Comcast is perpetually under quote-unquote cord-cutting pressure as people move away from traditional cable TV bundles. This showcases the value in their diversified business model, and it also indicates a clear ability to offset cable TV losses with higher prices on internet packages. However, it's important to keep in mind that not all of this growth is organic. Comcast has been highly acquisitive over the last decade. The acquisition of NBC Universal for just under $54 billion through 2 transactions transformed Comcast into the media conglomerate they are today, and the more recent acquisition of Sky added to that. Earnings per share advanced from 65 cents to $2.83 over this period, which is a compound annual growth rate of 17.76%. Very impressive in my view, especially considering all of the acquisitions. Share buybacks definitely helped to juice bottom line growth. Their outstanding share count is down by approximately 18% over the last 10 years. Looking forward, CFRA believes that Comcast will compound its earnings per share at an annual rate of 6% over the next 3 years. CFRA is factoring in the disruptions to various Comcast businesses, including the theme parks and film content. On the other hand, they believe the pandemic should create more demand for high-speed bundled connections, and the upcoming political season is a near-term tailwind for spending on TV advertising. This is a conservative forecast, but I think near-term caution is warranted. Comcast is unlikely to come out of this totally unscathed, but plowing ahead with mid-single-digit bottom-line growth through a once-in-100-year event? That proves out very resilient and a wonderful business model. Moving over to the balance sheet, Comcast has an okay financial position. It's not a sparkling balance sheet. There is a lot of debt, which isn't a surprise. Every single business line they run is capital intensive. Furthermore, those large aforementioned acquisitions have come at the cost of a lot of additional debt and now weigh on the balance sheet. That said, the company is certainly not in dire straits. The long-term debt-to-equity ratio is 1.18, while the interest coverage ratio is slightly under 5. I will say Comcast has historically operated with these kind of metrics. They're nothing new. There's more debt on the balance sheet now, but the company is also earning much more cash flow. Profitability is robust, and it's been improving of late. Over the last 5 years, the firm has averaged annual net margin of 14.61% and annual return on equity of 20.53%. The debt load has supercharged return on equity. However, there's been some very real margin expansion, and I think their pricing power when it comes to broadband internet packages bodes well for further margin expansion. Overall, Comcast strikes me as a great way to avoid a binary trade here. With or without a broader reopening of the US economy, Comcast should thrive. And with scale, huge barriers to entry, and the ability to operate as a local monopoly in many markets, the company benefits from numerous competitive advantages. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. The cord-cutting phenomenon hurts the company disproportionately. This affects them both on the cable video side, distribution of the business, and the cable network side, production. Less consumers watching traditional cable networks is a double whammy for Comcast. Comcast also faces the risk of technological obsolescence. If a better and/or cheaper way to access the internet can be scaled by a competitor, this would greatly impact the business model. 5G wireless could be such a threat. And while more of a near-term issue, theme parks are directly impacted by the pandemic. With these risks known, I still believe that Comcast makes a lot of sense for long-term dividend growth investors. That's especially true with the stock sporting an attractive valuation. The stock is available for a PE ratio of 17.9. That's demonstrably lower than the broader market's earnings multiple. Then there's cash flow. The price to cash flow ratio at 8.0 is slightly lower than the stock's own 3-year average price to cash flow ratio of 8.2. And the yield, as noted earlier, is lower than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 8%. This dividend growth rate is on the high end of what I ordinarily allow for, but I think Comcast deserves it. The balance sheet is the only real weakness here. When looking at the long-term earnings per share growth, long-term proven dividend growth, the low payout ratio, healthy free cash flow, and monopolistic attributes, I believe Comcast can do at least high single-digit dividend growth over the long run. There are near-term challenges, but this business has excellent long-term prospects. The dividend discount model analysis gives me a fair value of $49.68. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Comcast as a 3-star stock with a fair value estimate of $47. CFRA rates Comcast as a 5-star strong buy with a 12-month target price of $50. I came out very close to where CFRA is at. Averaging the three numbers out gives us a final valuation of $48.89, which would indicate the stock is possibly 10% undervalued. Here's the bottom line, guys. Comcast Corporation is a high-quality media conglomerate that's positioned to do well no matter what happens with a broader reopening of the U.S. economy. With a market-beating yield, more than a decade of consistent dividend raises, double-digit dividend growth, and the potential that shares are 10% undervalued, this looks like a great long-term bet for dividend growth investors. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including a link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is and am often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.